Hey everyone, welcome back to Corporate Decoder. Today, Fund just filed its N-CSR report and I'm seeing a few interesting moves in their investment strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a look at how the fund performed over the last fiscal year and what they are invested in right now. This document is a certified shareholder report for registered management investment companies. Think of it as a yearly checkup for investment funds, showing shareholders exactly what the fund has been up to. The company we are looking at today is the Variant Alternative Lending Fund. Its ticker symbol is XALFX. This fund focuses on lending money to businesses, specifically in alternative lending, which means it is not your typical bank loan. They are investing in things like litigation finance, real estate debt, and other specialized areas. Let's dive into how the fund performed for the fiscal year ending the 30th of April 2026. The fund delivered a net total return of plus 7.55%. Since it started, which was back in November 2024, it has generated an annualized net total return of about 8.86%. This is pretty good when you compare it to other similar investments that focus on generating income. The fund also made a big change this year, shifting from being a tender offer fund to an interval fund. This affects how investors can buy and sell shares. They also started paying out dividends monthly instead of quarterly, which gives investors more regular access to their earnings and helps the fund manage its cash better. The trailing distribution rate, or how much they paid out over the last year, is around 9%. This graph compares a hypothetical investment in the Variant Alternative Lending Fund against the Bloomberg US Aggregate Bond Index. For the year ending the 30th of April 2026, the fund returned 7.55%, while the bond index returned about 4.06%. Looking at the longer term, since its inception in November 2024, the fund has returned 8.86% annually compared to the bond index's 4.45% annually. This shows the fund has outperformed a more traditional bond index. Now, let's get into what the fund actually owns. This is the most interesting part for me. They have a highly diversified portfolio, but it is concentrated in credit facilities, making up 81.1% of their net assets. They've got about 1.3% in real estate debt, with a significant investment in something called BlackRock Monticello Debt REIT. Then there are secondaries, which means they are buying existing stakes in other investment funds. This category is around 4.4% of their assets. It includes investments in legalist dip funds. A big chunk, 16.9%, is in litigation finance. This is where they lend money to fund lawsuits. They have significant investments here like BEB SPV, ILC, and Steno agency funding. ILLC, interesting to note that some of these have variable interest rates tied to things like the 1-month CME term SOFR. Another large portion, 19.7%, is also in real estate debt. This includes various entities like Beehive Hospitality, Integrity RS, and MBC Variant SPV LLC. You can see a mix of fixed and variable rates here, with some loans carrying interest rates as high as 15%. The largest segment by far is specialty finance, making up 37.2% of their assets. This is a broad category, and it includes a wide array of investments like A&T Investments SAL, Copperpot Finance LLC, and Station Road Capital Management 2. LLC. Some of these carry very high interest rates. For instance, SSL DBI PLLC has an interest rate of 15.65%. Another one, Pure Active Transactions LLC, has an interest rate of 18%. These high rates are typical for specialized lending and reflect the higher risk involved. They also hold 7.5% in money market instruments, like the Goldman Sachs Financial Square Government Fund. This is essentially their cash equivalent, providing a bit of stability and liquidity. In total, their investments are valued at over $68 million, with a cost of about $71.9 million. This means that overall, their investments are currently worth a bit less than what they paid for them. Let's quickly recap the portfolio breakdown. Credit facilities are the dominant asset class at 81.1%. Money market instruments represent 7.5%, and private investment companies are at 5.7%. The rest are smaller allocations. This confirms the fund's strategy is heavily focused on lending. Looking at the statement of assets and liabilities, we see the total assets are over $72 million. On the liability side, they have some unrealized depreciation on open futures contracts, which is about $48,000, and other operational liabilities. The net assets, which is the value of the fund after deducting liabilities, stand at about $71.79 million. This is the figure that determines the net asset value per S-share. This statement shows how the fund made and spent money. They generated over $9 million in investment income. This came from interest on their loans, dividends, and other income sources. On the expense side, they paid out around $1.7 million. But importantly, the investment manager waived over $665,000 in fees. This fee waiver is a common way for fund managers to offset expenses and boost returns for shareholders, especially for newer funds. After all expenses, the fund had a net increase in net assets of over $5 million. They also had a net realized gain of around $167,000, but they experienced a net change in unrealized depreciation from their investments of over $3 million. This means the fair value of some of their investments decreased during the year on paper. This table shows how the fund's net assets changed over the year. Operations contributed over $5 million, while distributions to shareholders, which is money paid out, were over $8 million. Importantly, they sold shares worth over $26 million and repurchased shares worth about $8.5 million. This activity increased their net assets by nearly $20 million, bringing the total increase to over $16 million. The fund started the year with over $55 million in net assets and ended it with over $71 million. That is a solid growth. The statement of cash flows details the actual cash movements. Operating activities used over $11 million in cash. This sounds like a lot, but it is largely due to the purchases and sales of long-term investments. Financing activities, however, provided over $11.7 million in cash, mainly from the proceeds of shares sold. Their cash and restricted cash at the end of the period was about $617,000, which is mainly cash deposited with a broker for futures contracts. Let's look at the financial highlights per S Hare. For the year ended the 30th of April 2026, the net asset value per S Hare started at $24.98 and ended at $24.11. This shows a slight decrease in the net asset value per S Hare. Even though the fund's overall net assets grew, this is often due to distributions paid out to shareholders that reduce the per share value. The total return of 7.55% here reflects the change in net asset value plus distributions. The expense ratio, or the cost of running the fund, was about 1.42% after fee waivers for the institutional class shares. This is quite reasonable. These notes provide crucial details about the fund's accounting policies and risks. The fund values its investments at fair value. Since many of their investments are in private companies or complex credit facilities, they don't always have readily available market prices. In these cases, the fund uses fair value estimates. This often involves significant judgment and can lead to differences between the estimated value and what the investment might actually be worth when sold. Most of their investments, like money market instruments, fall into level 1, meaning they are valued using easily accessible market prices. However, a large portion, especially their credit facilities, fall into level 3. This means their value is based on inputs that are not easily observable in the market, requiring more estimation and judgment from the fund manager. For example, the discount rate used for credit facilities ranges from 17.7% to 20%. This reflects the higher risk associated with these types of investments. The fund outlines several significant risks. Limited liquidity is a major one. Because it is an interval fund, investors cannot redeem shares daily. They can only sell through quarterly repurchase offers, and there is no guarantee all requested shares will be bought back. It is also a non-diversified fund, meaning it can invest a larger portion of its assets in a single issuer. This increases the risk if that one investment performs poorly. Investing in private markets means dealing with less information and often illiquid assets. The fund relies heavily on its managers' ability to get and assess data for these companies. There are also credit risks. If a borrower defaults or cannot make payments, the fund could lose money. They mention SOFR, which is the Secured Overnight Financing Rate, a key benchmark rate. SOFR is relatively new, and its future performance is uncertain, which can impact variable rate investments. The fund conducts quarterly repurchase offers, usually for at least 5% of its outstanding shares. If more investors want to sell than the fund can buy, they might only be able to repurchase a portion of what is requested. The fund has outstanding commitments to lend more money in the future, totaling nearly $3.7 million. This means they are contractually obligated to provide additional funding for some of their investments. This section introduces the Board of Trustees and Officers. It is important to see who is overseeing the fund. The independent trustees are David G. Lee, Robert Seyfarth, and Gary E. Shugru. Then there are interested trustees and officers like Robert W. Elsesser and Kurt Fintel, who are also principals at the investment manager. Bernadette Murphy serves as Chief Compliance Officer. It is always good to see if the people managing the fund have their own money in it. Robert W. Elsesser owns shares in the dollar range of $100,000 and $1 to $500,000. Kurt Fintel owns over $1 million worth of shares, and JB Hayes owns between $500,001 and $1 million. This level of personal investment suggests they are aligned with the fund's success. The portfolio manager's compensation is a mix of base salary and performance bonuses, tied to both their individual performance and the overall success of the investment manager's business. Now, what is my take on all this? The fund has delivered a solid return in its first full year, outperforming a benchmark bond index. Their strategy is clearly focused on generating income through specialized lending, which comes with higher interest rates but also higher risk. The large allocation to specialty finance and litigation finance, with loans carrying double-digit interest rates, shows a high-risk, high-reward approach. The fact that the investment manager is waiving fees is a positive sign, showing commitment to making the fund attractive. However, the limited liquidity of an interval fund structure, combined with the inherent risks of private markets and credit, means this fund is definitely not for everyone. It is for investors who can tolerate risk and don't need immediate access to their money. The main story here is the fund's aggressive income generating strategy and its ability to navigate challenging private markets while offering decent returns. The risk I am watching is how they manage the credit risk within their specialized lending portfolio, particularly if economic conditions worsen. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord.